Hello. So today we are going to be looking at chapter 11, which is about investment or investing. So first of all, we're going to start with very basics here. What's investment? What does it mean? What does it mean to be an investor, right? So investment is something that is bought for future financial benefit. So you purchase it now, but you're thinking about the future and you're trying to get benefit, financially speaking, in the future. Right? So one of the reasons for investing, or why investing is a big deal, why people talk about it, one is because they're trying to get more money in the future, but also investing promotes economic growth and works to contribute to a nation's wealth. So if you're investing a lot of things in different businesses and different areas, then you're laying different money out in order to grow your economy in the future. Financial systems overall, their goal is to help people be able to invest by linking borrowers of money to savers of money. Okay, so there are lots and lots of different types of investments. Some of them are higher risk than others. So as we're going over talking about different types of investments, I want you to kind of keep in mind what types of investments are high risk, what types of investments are low risk, and kind of think about why are these higher risk than other ones. Okay, so some of the types of investments include stocks. That's probably the most commonly talked about. There are also mutual funds. Mutual funds are a lower risk than stocks, but they still classify in high risk overall. Penny stocks and collectibles. So, like if you collect different things, whether it's Pokemon cards or action figures or tons of things, those are, people think they'll sell them in the future and gain investment. So all of those things you can classify. We're going to focus mostly on the first two, stocks and mutual funds. Low risk investments include bonds, which have three main parts to them. Bonds, a lot of times we'll refer to them as savings bonds. Savings bonds are issued by the government, so that's the type of bonds that I usually focus on, although corporations can also sell bonds, but they're much more likely to talk about bonds in terms of the government buying and selling bonds. So there's three different parts. You have the coupon rate, maturity, and par value. So maturity, that refers to how long it takes for the bond to reach its full investing value. And the coupon rate and the par value have to do with how much is it worth now is kind of the par value, and the coupon rate is the percent of return that you're getting, that percent of interest that is growing. So those are the three kind of main parts of a bond. Whatever type of bond it is, there's many different types of bonds, but most commonly, at least in my class, we usually talk about savings bonds, which are issued by the government. Other low risk investments include certificates of deposit, also known as CDs. So CD is not, in this case, a retro or vintage music playing device. It's a certificate of deposit. So basically, you're committing to not touching your money in the bank for a certain period of time. Sometimes it can be as short as 6 months. Sometimes it's several years. And so you commit to not taking your money from an account for a period of time. And banks, credit unions give you higher interest rates because you're committing that you're going to leave your money there. Right? Savings accounts in banks or credit unions, that's a low risk type of investment. Right? You're putting it there for future financial benefit. You usually get a percent of interest for saving and leaving it in the bank. Right now we've had very low interest rates, so not a lot of money is being earned by people having their money in savings accounts in banks or credit unions. Also, money market funds is another lower risk investment that you might encounter at some point later in your life. So a little zoomed in picture about a couple of our types of investments. Stocks are where somebody's getting a certificate that they own part of a company. So when you purchase a stock, you become what's known as a shareholder. So you own a share, so you own a small part of that company. Depending on how many shares you own, depends on how large of a shareholder you are. So for stocks, you're owning a very, very small part of the company. So you're helping that company be able to grow because you are contributing and buying parts of it. Right? Stockbrokers are people who can sell stocks. Not everybody can sell stocks. You can't open a stock selling shop tomorrow per se. You have to go through some training and actually be an official stockbroker. Now, some stockbrokers do have some fully online platforms, and so there's not as much as there used to be involved, where some people are, it almost feels like you're buying and selling stocks yourself, but technically it does go through an intermediary person of the stockbroker in order for that action to actually buy and sell stocks happening. Mutual funds. This is a type of investment that many people often start as their first kind of major investment after a savings account. So when we look at mutual funds are where there's an organization that will pull all of your money together from savings from lots of different individuals, and they'll invest in stocks and in bonds and other financial assets. So mutual funds, you're getting just a teeny part of different bonds, of different stocks, of lots of different things. So instead of buying one specific stock, you're buying like a small amount of a bunch of different stocks. There's lots of different kinds of mutual funds. Some of them, like the American Growth Fund of America, Vanguard Total Stock Market Index Fund. Vanguard's a very big company that has lots of different mutual funds. And when you're talking about mutual funds, you might see that they will follow a particular index. You might see where they follow a particular industry. So there's very kind of common beginning of investing. So for stocks, you actually are owning a very small part of one particular company that you're purchasing. For mutual funds, you are buying many different stocks. So you're owning small parts of many different types of companies for a mutual fund. That's one of your, and you might also have bonds for a mutual fund. Okay. To think about which of the different types of investing that we talked about, what things are high risk, what things are low risk, and see whether or not you can think of which types of the investments that we talked about, which ones of those are high risk. Stocks, yes. Mutual funds, penny stocks, collectibles. And the low risk ones are bonds, certificates of deposit or CDs, and savings accounts in either banks or credit unions, which credit unions are very similar to banks, but usually you have to be part of a specific industry or live in a certain area. And so there's a little bit of membership where the people that have accounts there are more owners, whereas banks, it's kind of the business model is set up a little different, but they function very similarly, especially with some of the newer regulations that have come out for the past several years. And then also low risk is money market funds. Okay, so diversification is a very important concept. So diversification is the strategy of spreading investments out to reduce risk. So one of the old kind of quotes that goes with diversification is this idea of don't put all of your eggs in one basket. Okay, because if you put all your eggs in one basket and something happens to that basket, all of your eggs might crack, right? So don't put all of your eggs in one basket. So you don't have anything that you were hoping for, right? That's the metaphor, right? So that this old adage, don't put all of your eggs in one basket. So you want to spread out your risk. You want to buy from different companies. You want to have some stocks, some mutual funds, some bonds, stuff in savings. You want to spread it out over lots of different things because you don't want to lose all of your money if this one company has problems. So I want you to think about which of our different types of investing, which one of them is naturally diverse, that you naturally spread out your investing into several different things. Mutual funds. Yeah, mutual funds are naturally diverse. You buy little bits and pieces of lots of different stocks, lots of different bonds, right? Diversification is an extremely important part of investing. You very much want to make sure that your portfolio, sometimes we'll call it all of your investment holdings, are diverse, that you have, you don't have too much in too many different categories, that you want to make sure that you don't have too much in one category and almost nothing in another category. Right? So there's a few key indices or indexes. And so what an index is, or an index is where you follow the stock market. And so you're using this measure of just a small, limited number of stocks, but are representative for the whole stock market. The stock market has many, almost all the different businesses in it, right? And you can't keep track of every single business. So they pick specific ones that are just limited in number, but are representative for how the whole market is doing. And so that's what a key index is. Okay, so there's the Dow Jones, which has 30 different companies. So of all the different companies that exist, they picked 30 companies, and that's what they follow for the Dow Jones Industrial Average, the Dow Jones, the Dow, whatever they call it, right? That follows 30 companies, and they say, okay, based on these 30 companies, this is how businesses are doing. Okay, so they have to pick very big, very foundational companies that are going to be affecting a lot of different other companies, right? Then there's the S&P 500. And if you think about it, how many companies do you think they're going to have? Yeah, 500 companies. So they're going to follow 500 different companies. And so they look at a wider range, but still there's a lot more than 500 different companies that are traded on the stock market. And so they'll look at those. There are other indices that you can look at, but those are probably the two most common indexes that we will see talked about. Okay, so there's a couple different types of markets. One type of market is called the bear market. And the bear market is a market where the prices of most stocks are falling. So when the economy is in such a place where most companies are losing money and the stock prices are falling, then we're in a bear market. For example, you see that your stock markets are falling, and I want you to think about when in your lifetime have you seen a bear market where most companies, not every company, but most companies are losing money and are not doing well, and their stock prices have fallen. Okay, the other type of market is a bull market, and that is the exact opposite, right? We're in a market where prices for stocks are mostly rising. So when you have stocks steadily rising, that is considered a bull market. So think about what time period that you've lived through have you seen a bull market where most businesses were doing reasonably well and most stock prices were going up and the prices of stocks were generically rising. Okay. And then we also have this concept of liquidity, which we talked a little bit about when we were looking in chapter 10, more of that content in money, but the liquidity also makes a difference when we're talking about investing. So liquidity, remember, is the ability to be used or converted into cash. So it doesn't have to do with, is it solid, is it liquid, is it gas? It's not the states of matter, right? This is how close you are to cash. It's how easy can you take an asset, take something that you own, and turn it into what you want, right? And so that's usually equated to how easy is it to get it to cash, right? So your importance of that is investors sometimes will have to choose between liquidity of something and the rate of return, or how much money they're making. So some things they can make a good amount of money from, but it's not as liquid as other things. So one of the reasons why you often have savings accounts is because if you end up where you're in a not so good personal finance kind of situation, you can use the money that you had set aside, in that emergency to cover the costs you need. Whereas if you had all of that money in stocks, then you would have to sell the stocks and then use that cash. But if you sell stocks when you're not doing well, if you're not doing well financially because there's a bear market and there's a high amount of unemployment, then your stock prices might be less that you sell than it was when you originally purchased them. So that's not really the goal, right? So savings accounts are very liquid. Stocks are not as liquid, though they're relatively easy to sell. Houses are considered an investment property. So that is not liquid because you have to find a buyer to get in the house to have the funds, right? So it really kind of depends. And usually you'll see how liquid something is versus the rate of return, how much money they can make. That's something that people will trade off about when you were looking at investment. Okay, so big things to understand: what kinds of things are high risk, what kinds of things are low risk. You want to have some high risk investments and some low risk investments. So the higher the risk, the greater the reward. The lower the risk, usually the less the reward. So that whole piece of having a varied type of investing, which is called diversification, right, is hugely important for investing.